So if Bitcoin's rebound was the comeback, this liquidation bloodbath was the knockout punch. Because what just happened across crypto wasn't a normal pullback. It was forced selling at scale. More than 335,000 traders were liquidated. The vast majority were retail longs, concentrated on Binance, Bybit, and OKX, where leverage remains highest. Even whales weren't spared. The trader known as Machi Brother reportedly took losses north of $120 million, and miners, including Marathon Digital, were seen moving Bitcoin on-chain as profitability pressure intensified. Analysts tracked the damage in real time. CoinGlass, Bitfinex, and CryptoQuant, with CryptoQuant's Sean Rose highlighting a critical data point. 44% of Bitcoin's circulating supply is now underwater. Liquidations surged into the $1 to $2.5 billion range across multiple 24-hour windows, ranking this event among the 10 largest liquidation cascades ever. Longs dominated the wreckage. Roughly $1 to $1.5 billion in bullish positions were wiped out. By asset, Ethereum led, with roughly $960 million. Bitcoin followed, near $680 million, and Solana added another $160+ million. At the same time, total crypto market cap fell into the $2.3 to $2.5 trillion range, while realized losses for Bitcoin hit an all-time high, approximately $3.2 billion on an entity-adjusted basis. That's not panic selling. That's mechanical liquidation. This didn't happen all at once. Liquidation waves built from January 29th through February 6th, with the most violent hits landing February 4th and 5th, right as Bitcoin flushed below $60,000. By February 7th through the 10th, daily liquidations cooled toward the $500 million range, signaling that the forced selling phase was largely complete. That timing matters. Geographically, this was amplified by Asia-heavy exchanges. Roughly 60% of liquidation volume ran through Binance and Bybit, with South Korea's high-leverage trading culture magnifying the downside. In the U.S., Coinbase reflected a different story. Less leverage, more institutional repositioning, and flows tied to broader macro risk sentiment. This wasn't a single market breaking. It was global leverage unwinding simultaneously. Because leverage met reality. Traders were running 5 times, 10 times, even 100 times positions into a macro environment that turned hostile, fast. Tech earnings disappointed. Microsoft and AMD weakness spilled into risk assets. Tariff rhetoric resurfaced. The Fed stayed firm. Liquidity thinned. And when price slipped just far enough, algorithms took over. Margins failed. Stops triggered. And dips turned into avalanches. This wasn't fear-driven selling. It was a deleveraging loop in a fragile market. That's the textbook definition of capitulation. Now for the important part. Leverage across futures markets has dropped roughly 20%. Open interest has reset closer to $30 billion. That creates cleaner conditions for recovery. If ETF inflows resume and macro pressure eases, a 10 to 20% upside move becomes realistic. Not guaranteed, but viable. However, another macro shock, especially around tariffs or rates, could still trigger a second wave of forced selling. Longer term, though, this event did what markets often need. It flushed weak hands, and when leverage clears, price discovery can start again.